Hello, welcome. This is eurusd on the 3-month time frame. Right, we can see that at the beginning of 2006, this market was rolling up. This market was bullish, and it rapidly moved around here and dropped down, leaving some gap here, and we dropped and we started moving downwards. So basically, we are trying to reinforce the standard trading model, but mostly here I'm going to concentrate on the bearish version of the standard trading model, which we represented like this, where we said we need a strip of liquidity, the first break of structure, then this high, this is where we take our sell order to potentially take our profit at this lower lows in the long run. Partials profits can always be taken at this leg right here. The nearest liquidity is lying on this leg. So let's look at this chart on eurusd 3-month time frame, whereby you can see this market rallied up and dropped. This is a sign that the market is reversing. Market always, when grabbing liquidity, when grabbing a swing, liquidity is a place where is a place where there are swing highs, and where traders have set their stop losses. The market always tends to go grab that liquidity and move against them, right? So when most of the time, when you have a liquidity, market always moves right like this. But once it's closer to liquidity, it flashes, right? Moves with a bigger momentum, then moves on the opposite direction with a bigger momentum. That even the guys that have been taken out, if they are trying to get into the trade, right, the trend, find it very difficult. It never leaves an opportunity for them to get in. So right here we can see this market rallied up and dropped down, because it means that there was a strip of liquidity right there, and we need to find the first break of structure. Before that, of course, I'm going ahead. I'm going so fast. Let's look at this. Some external liquidity was taken below there. Back there, just go check out on your charts back before 2006. I can assume there was a strip of liquidity there. Then after that, this is external liquidity, right? External liquidity was swept, and then this market was rolling down to go look for internal liquidity. Where was internal liquidity lying? See, the internal liquidity was lying here. The market just came for it. After sweeping the external liquidity and rolling down, showing us that it has a desire. This market is angrily bearish, right? It wants to go down by leaving this gap. So we went and took internal liquidity right here. And after we took this internal liquidity, this guy becomes the external liquidity. What is the internal liquidity lying in between this leg? You see it lying on this swing high right here. Internal liquidity always lies on swing highs and on the imbalances, right? So this is another added confluence to support that this market was just going to for this liquidity line here and to refill this imbalance, and we move down again for the external liquidity, right, that are swept. After we took this external liquidity, right, we formed another external liquidity here. So the market is now rallying up for internal liquidity that is lying around here. This is where now our model comes in. We said we need a strip of liquidity, right? The first break of structure, strip of liquidity, first break of structure. We look for it in between this leg on the lower time frames, right? Whereby we set our order on that high, and our stop loss right above here to ride the market, this place here. But also I mentioned in some videos that this one here, this pattern here, I told you that it is something that repeats in the market, and it is better if you could just backtest it and try find out what that pattern means. Of course, what normally happens after we form this kind of pattern, this pattern, like we can represent like this. Market moves up, comes take that low, comes take that high, and boom, right? We see the market bullish, right? Forming this low, right? The market moves up, creating this swing high, inducing engineered liquidity here, then comes, takes all these orders that were lying here, right? Take all these stop losses that are lying here, then boom, went up. After taking this higher high, then it reverses with a massive momentum, with a bigger momentum, it drops down with a bigger momentum. That's what you just seen here. That is just what is just seen what is happening here. Yeah. Without dropping down on the lower time frame to find out the first break of structure. Remember, we are operating on the 3-month time frame, but you can always drop down on the lower time frame to find the first break of structure that is very, very clear on this leg. Right? I'm very, very sure it's around somewhere there. And see the market rally down. We swept this liquidity, as you can say. And we are targeting, see, it took this internal liquidity, right? So now we are targeting for the external liquidity, right here. Right, this way you're targeting. But before we reach there, we have another internal liquidity here. The market comes and takes that internal liquidity. This one follows the standard, the bullish version of the standard trading model. Oh, I've drawn it bad, so let me try to draw it well. Bullish version of the standard trading model, where we said we need a sweep of liquidity over here and a first break of structure. At this lower low, this is where we set our buy order to potentially take the highs in the long run, but we can always take partials. The liquidity is lying on this leg, right? Because we don't know what the market will do. Just our work is to predict. So you can see the other sweep of liquidity here before this strong high was created. So of course, naturally we should be looking for the first break of structure in over this leg, and we can see the one that is very, very conspicuous was this guy here. This was on the 3-month time frame, and its lower low was right here. So logically, following this model, we are supposed to set ourselves over here and ride the market to potentially take these higher highs. But you can always say take partials on this leg. Yeah, you can see the market came, took this high, but we can always refine our stop losses by dropping down on the lower time frame by doing the top-down analysis. Right, you can see this market came down to somewhere here, around here, and took some liquidity, but this guy at the stronger high was not taken. So dropping down on the lower time frame, maybe you can find the first break of structure that was lying here, right? And the market reversed off of it, and again, boom, there is the same pattern that I just indicated here, right? Naturally, we will expect the market to rally up over here, and we take our sell there, because following the bearish version of the standard trading model, we needed a sweep of liquidity, which we have here, the engineered one, and the first break of structure that is very, very clear with this guy around here, and it's high right here. This is where we set our sell order to potentially take these lower lows. But with this one, this pattern here, you should backtest it. Because what it usually does, when you see something like this, then you just mark that liquidity on top of it and start anticipating a sell from there. Don't expect it to sweep the liquidity that is over above there. Yeah, it usually just takes that higher high and starts the process of reversing. Right? So it is very, very important where you see this kind of pattern, that we always start to anticipate for a sell and that when that high is taken, yeah, it might not even mitigate this goalkeeper here. There is a goalkeeper, right? So you have a sweep of liquidity to even mitigate it. So this is where you should be looking for our bearish version of the standard trading model to ride the market to the targets, because this was the long-term the long-term target that we expected after this guy was taken. This market was to rally to take this high. But this one was just a reaction of the sweep of liquidity right here, right? I don't know whether someone is understanding me. Yep, but that is exactly how I do in this market. And moving on, we can see clearly that some liquidity was taken here, right? There was some form of manipulation here. And right here, you can see, this guy? This guy right here, this liquidity lying here. Liquidity was lying here. What do we expect of that sweep of liquidity? Market will always manipulate and go to reverse from some form of I call it goalkeeper on myself. So the nearest guy we can see here on the monthly was this guy, this breaker block over here. Okay, there's a breaker block over here. That's also on the monthly, but you can always drop down on the lower time frame without even taking your eyes off of this guy. You can find out the goalkeeper that was lying on this leg. Yeah, where the nearest one that after this sweep of liquid the market could reverse from. You can see this guy was mitigated and we moved down. Moving down, we had a clear sweep of liquidity here, so this is a manipulation, and naturally we would expect the market to come retest some first break of structure that was around here and boom to take these high highs. That's following the bullish version of the standard trading model. Everything that I'm talking here, if you've not used the introduction of the standard trading model, it is better for you to be informed of it, to be enlightened of it, to know of it before, because I might be talking things that you don't understand. So here I have a sweep of liquidity here. You can see the first of break of structure that is very, very conspicuous right here on this leg. We don't see it, right? But dropping down on the lower time frame, we can see it. Yeah, can guarantee that. But even without that, you can see that the liquidity was lying here before we drop down to find the first break of structure. See, the liquidity was lying here in form of what? An imbalance, that's an FVG. After we took this external liquidity, then we are coming now to retest the internal liquidity where it was lying here, form of what? An imbalance, an FVG. Right? I'm very sure the first of break of structure was around here, right? Somewhere here. Just go check out. And there is, yeah, we came now. There is, of course, we needed some manipulation, and we come for this defender right here, for this goalkeeper right here, where we reacted off that after all, we're taking all that liquidity above there. And we reacted off of that, right? After reacting off of that, of this goalkeeper here, you will naturally expect, right, for the market to take this high. But I said, you take partials, the nearest liquidity. The nearest liquidity was lying around here, right? This guy here, right here. Just take your order there. But we can all see with our eyes wide open that this market was bearish. Who cannot see that? Can all see that this market was bearish. So, why would you want this guy to be taken after the sweep of this liquidity? Right? Not okay, it can be taken because we've not yet mitigated this guy. Oh, this one is just as one swing. But in the short term, we should first of all react of the market react of liquidity, yeah, the nearest liquidity before we rally up. So, following this bearish version still of the standard trading model, you can see there was a liquidity taken around here, external liquidity taken here, and we go to look for the first break of structure, which we just see here. It's around here. Drop down to the lower time frame, you can see it very, very clearly. Then it's high right here. This is where you set your sell order. you sell order right here, stop loss about this guy here. But you can see this market was going over to do what? To mitigate the goalkeeper, which was a line around here. Or it was going to, for the faster break of structures on the lower time frames, just refining the stop loss, right? And what is the target? And where is the target? Our target. You would expect this lower lows to be taken, and you can see this guy was smashed right here. But in the long run, you can see all these lower lows were taken. The liquidity was taken, and after taking that liquidity, you can see now the market is now gaining momentum to rally up. Why do you think we are going? Why do we think we are going? Yeah, that is the question that we should ask ourselves. You can see after this liquidity was taken, right? After this external liquidity was taken, so the market now is trying to look for internal liquidity. Why is it an internal liquidity line? First of all, we have an FBG here. Yeah. So we drop down on the lower time frame to see what's the market structure for this leg around here. But what you can see now on the monthly is that at least we have a clue that there was a first break of structure right around above here. And its lower low where we're supposed to set our buy order was around here, and we can see it was smashed, it was taken. Just the market wicked on it, right? But naturally, it just wicked on it, but naturally we would expect the market to react off of some goalkeeper below here before it rallies up fully now. Let's drop down on the lower time frame and see what was happening. Oh, this is the same chart on the monthly, but this is now with a little bit of lipstick on it. Where I said there was a sweep of liquidity here, but naturally on the bigger time frame, right? On the bigger version of the standard trading model, which I just represented it before. We represent like this with a sweep of liquidity, first break of structure. This high set your sell order and smash these high highs in the long run. And you can see the market was the first break of structure that is very, very conspicuous of this leg was this guy here. So naturally, where do you expect this market to reverse from? This guy. This is where, in the long run, this is where we will expect, if the market reaches this place, we expect to sell off and target this lower lows. That is the long-term take profit, but we can always take partials at the nearest liquidity. We just react above that because we are trying just to catch a few pips as guys. You don't want to, as we are not investors in this market. Small pips. If the market now wants to take this high, then we could have already banked some money in our accounts. So you can see there was a sweep of liquidity here, manipulation. All this concept I've just been talking all about. Sweep of liquidity, manipulation, boom, downwards. Sweep of liquidity here. We took this guy, this was engineered one, right? It was a little bit crazy. Engineered, then boom, came down. You can also see here, engineered one, sweep of liquidity right here, and see manipulation, and boom, we came down. Yeah, that is it. Sweep, all of this was just craziness, and we came down. We came here, we swept this guy, at least we came manipulation again. Yeah, that is it. That's what the market does, right? Yeah, I believe there was some liquidity swept there, and this was just kind of manipulation around here. So it is what it is. That's exactly what this market is doing on the 3-month time frame. Just drop down on the lower time frame to see what is this market is all about. This one was now on the monthly time frame. Yeah. I'm just going now to move a bit quick because I've just done a lot of work on the 3-month. So you can see this was the guy that I marked on the 3-month time frame, and you can see this market just reacted of that, leaving some liquidity line here. Oh, this guy mitigated? I'm not that sure. So we'll expect to see that. sweep of liquidity. The first break of structure that's conspicuous on the monthly was this guy around here. So this high, this was where you're supposed to set your sell order to ride this market to take this lower lows. But we always sweep liquidity first and we manipulate before we rally down. That's the logic behind this guy, behind this setup. Alright, that is it. So what was happening here was that before this rally, you can see this market came and took out this internal liquidity, right? Just wicked on it. But naturally, we expect the market to react off of where? Of this goalkeeper. And you can see the market reacting off that goalkeeper, right? And boom, rolled up. That's exactly what is happening. This was a goalkeeper that I marked on the 3-month time frame, but you can see there was some form of another goalkeeper that was clear here on the monthly, right? You could mark maybe him now on there and find your entry, all this zone here. But when you drop down still on the weekly, maybe you can see very clearly what this goalkeeper was doing here. Now this was just an expanded version of it, right? Market always sweeps liquidity, manipulates first before it moves. You can see here sweep of liquidity manipulation right here before we move down. You can see the sweep of liquidity here, the manipulation, and we move down. Crazy, right? Yeah, this is what spending a lot of time on charts means. Just read price action like it is just something. It's just an easy thing. You don't have to stress about it, or you don't have to complicate anything. Just keep it everything very, very simple. So you're right here, right? You can say market just weak on it, but this guy here will expect to drop down somewhere here, or before we now take this high highs, or we can take this high highs first, or we drop down. So you can manipulate above there, come down now. Now for a big volume to now smash those high highs to come to this guy here. But there's a lot of reactions of this place. Dropping down on the low time. This is the monthly time frame. Right, you can see what was happening there. You can see how this market is trying to reach for this liquidity, but we are now currently reacting off of some zone here, right? Of course, this leg here, after we took this internal liquidity here, so we'll expect to go for this external liquidity here. But before we reach this external liquidity, we should react off of this premium zone. There should be fast break of structure around here where we react off of that place before maybe we can smash these high highs, right? So dropping down on the weekly. What we can see on the weekly right here is that we had there was of course a sweep of liquidity right there. It was just all this one was, I told you, was just manipulation. I saw this somewhere there, yeah, but it's kind of before we drop down. I saw the first break of structure that's very, very clear with this guy around here. Yeah, and this guy above here was just the first break of structures high following the bearish version of the standard trading model. One model for life. Simple, keep it simple. Sweep of liquidity, first leg, the first break of structure, then it's high right here. Set your order there to potentially smash take your profits at this low. But we can always take partials over on the course of this leg, or here nearest liquidities. Yeah, on the lower time frames. So we had a sweep of liquidity here on the weekly, and we can see the market reacting of that zone. Maybe now should look for an entry after the sweep of this liquidity. Yeah, so this market is going down, but I would expect this market to reverse. Okay, What? This guys, does it mean that this is likely to check these lower lows? Okay. Naturally, you expect after the market reacts of that high, after sweeping liquidity, we need some manipulation here, right? So you expect the market to drop down a bit somewhere there, and we rally up to take that manipulate a bit again before we can do something. Maybe to check this lower lows. You see, anything can happen in the long run. The long term, we're expecting these high highs to be taken. So there will be a manipulation down there a bit, and boom. Take this lower lows. Anything can happen. So we just have to follow what is happening, and we move. Dropping down on the daily. This is what you can see on the daily. Okay, on the daily there already is a manipulation. On the daily, after we took this first break of structures high on the weekly, the market went up, then closed, then we manipulated, right? After this manipulation, we are starting now to drop down. Where are we going? We should react over this guy. Should have something there. And where again? In the long run. In the long run, I will expect this market to come here. To come here to react to some gold paper here. And so this is where I will start anticipating for a buy. Take this guy, react of this guy. We start looking for the bullish version of the standard trading model, right? But around here, when this market is going down, we are now focused on just the bearish version of the trading model. And here, this is exactly what is happening here. It has not formed any displacement. So let's see. There's no, okay, we will come. Every reaction of this, take this guy and take these highs. Yeah, that's what I can predict on. Moving on, okay. We now drop down massively on the 30 minutes time frame. This was just what was happening yesterday. Yesterday this setup just printed. We had a sweep of liquidity here. The first break of structure, so it's big one right here, and this guy is here. Those are the ones that we set our order. Our stop was tight right above this guy, and ride the market to our targets. That's the bearish version of the standard trading model. Yeah, so we took some external liquidity. We came for internal liquidity around here, right? This first, so this drop here was kind of length. There's some liquidity here, and it's reacted of this guy, right? Of this guy. This was his internal liquidity, and he went up for some internal liquidity on this leg again. So we took him and brought down to take this external liquidity. Took external liquidity, then we are now moving for an internal liquidity, which is this guy. Came to him and boom, ride it to our targets. It was just as simple as that. You can see this guy here. Take care, my friends. This back tasting. It's crazy. Yep. So you can see that guy, this guy here reacting with that, and boom. We never even reached this guy here. This go, or did we? Okay, we did. I think we did. We reacted of this goalkeeper. We touched this goalkeeper and boom. We went down. Yep. So that is some of the times when this model does not work. But when you drop down on the lower time frame to see what was happening on this leg, you might find that there was a break of structure around there, right? Before you ride on. But But again, you should always look for the high quality setup, because here you don't even have a clear sweep of liquidity for this guy here. You don't have even a clear sweep of liquidity. Yeah. So we just wait the market to print our setup and then we get in. That was the simple what I wanted just to say on this video. And I hope someone has gotten something. And I was also trying to test for this video, because most of the videos, the video I just uploaded, when I play it here on my library, the audio is very, very clear. But when I upload it on YouTube, there is some form of audio distortion, glitchiness. I don't know where the problem is coming from. I'm just trying to figure it out. Want to test this one also, whether it's still the audio has still a problem. Maybe if you know how to fix it, you can comment and you can tell me how I can fix it, so that we move together. We move together. Yes, that is it. Thank you so much for watching. Yeah, thank you so much for watching, and take care. Today is a Tuesday, 2nd January, and the markets are good. So let's eat from these markets. Yeah, so you can, there's an assignment. Yeah, we check out what was happening here. What is the explanation of this trade here? So, but though this one was just, I can't take this one, because this is now standing in front of a moving trend, or trying to catch a falling knife. This is exactly what was it. But it was just a way of understanding where the market is going to reach for. So thank you so much, and if you're new, you can always subscribe, like the video, so that it can go viral and our family increases. Thank you so much, and take care of yourselves. Bye.